Hi everybody, this is Ian, CEO of Applicator. I would like to share our complete guide to security token offering. It's a pretty new topic and interesting. It's definitely the space that is evolving, and a lot of people from both cryptocurrency and blockchain communities and capital markets have a lot of hopes for, and they see a lot of perspective here. So why don't we just jump straight into the topic and go through this guide prepared by Applicator's consulting department. Let me remind that at our consulting department we do um, all kinds of things like white papers preparation, development of the business plans, coaching, general advisory, and everything related to the growth of business, in particular in the blockchain and cryptocurrency space. So, what is an STO? Basically, it's the process of issuing coins or tokens for a stakeholder to invest for future profit. The issued assets guarantee investors certain rights of future dividend payments. There can be different types of securities tokenized, such as bonds, stocks, shares, including venture capital and private equity, revenue participation notes, convertible notes, and whatnot. So, in fact, STO is a merge of the two worlds. The world of the early um, phenomenon, such as initial coin offerings, which was considered as the security in most cases by the SEC, but due to the fact that they did not have the clear conclusion on that previously, there have been a lot of token launches that have been launched without any formal procedures kept, which definitely helped the space acquire its awareness. And the second world is the more conventional securities world. So the STO for those who are more conventional is the way to have all the protection that the laws and regulations provide. But that said, they would still have the upfront um, opportunity of leveraging the future innovation in case if the token component of the STO will acquire a certain pace and speed and get the traction of the investors later on. So you will be able to easily liquidate your token on the markets. So let's see, what's the difference between ICOs and STOs? So the process of STO launch is the same as the ICO process from the mechanics. So what we have is the same Ethereum network or the same other most popular networks out there as the underlying layer for the digital ledger, for the distributed ledger. Um, but the major difference is in the token's characteristics, and in particular what we consider the token to represent and reflect in the real world. So security tokens are backed by the real world assets, and they are designed in compliance with regulatory governance. ICO presents coins and tokens that are utility tokens, so they have some usage on the system, but they should not offer, or they should not promise a future dividend. That's the key difference between security tokens and utility tokens. Um, the key facts about STOs is that STOs have recently gained much more popularity than ICOs due to particularly the regulatory compliance and safety in terms of security. They've been conducting more than 100 STOs as of 2018, according to Invara's annual report. Um, at the contrary, ICOs were fading down. So the industries for which the STOs have been um, interesting are investments in trading, technology, financial services, real estate, blockchain and cryptocurrencies, advertising and real estate, entertainment and sport, business services, automobile and transportation, fintech, healthcare, and so on. As I mentioned, the number of ICOs and the capitalization of ICOs was decreasing throughout the 2018 and therefore 2019 as well. And STOs have basically emerged as the evolution on top of the ICO's technical infrastructure, having the regulatory protection, and it's slowly, um, uh, picking up the speed. Among the key, well, certainly it has. It has certain issues. Investors have a lot of reservation and stuff like that. So um, there would be several types of investors whom you would approach to attract them to your STOs. Firstly, these are the investors who've been previously familiar with the ICO market, and you would appeal to them saying, "Hey guys, you've been in the space, you've been trading cryptocurrencies, you've been investing in the ICOs before, so you know the game, right? Now." We are in the STO era. We're launching the STO. Why don't you invest? Having now more of the regulatory protection for your investments, and so in principle, these people would be the most susceptible to such offering because they know it all. Like they know what the token is. Um, they've kind of been there, done that. Um, one of the drawbacks or barriers that you may have is that many of such investors have traditionally been retail investors. So, due to the lack of regulations and lack of necessity to pitch to institutional and accredited investors, it was possible for ICO projects to basically appeal to the crowds, regardless of any investor uh, maturity criteria. So those people will, in many cases, be no-go for your security token offering, but for sure it will depend on what kind of regulation exemptions you are falling under, and we're going to review it a little bit later for the United States of America and several other countries, uh, which are the most attractive for the STO organization. The second group of investors would be the conventional investors who've been previously investing their venture and private equity capital in the companies, and they do have the upside, although the token offering as such is not something they are familiar with. Um, they get the upside. They get the potential of selling their tokens whenever they get out there on the market. So as the investors, they don't need to wait for 5 years or 10 years to exit from a deal or exit from the fund. By organizing a traded market for the token, they can exit at any time when the price is right for them, when the moment is right for them, and it democratizes the space in a way that other people can also jump in. After the token representing an investment has been issued on the market. For these kinds of investors, the best way to position the security token offering is basically positioning it as the conventional investment opportunity, but with this upside that the technology and liquid markets enabled by the token and exchanges are offering to them. So the benefits of the security token offering have been pretty clear. They are more transparent. There is a very clear KYC and AML verification. There is a clear protection through the regulation, which say what kind of investors you can attract to your STO, and as such, whom you have to avoid and how you have to do your offering. Let's go through the key jurisdictions for the security token offerings. United States of America, without doubt, is the largest economy in the world, and every project, and there is a reason for that every project wants to be compliant with the SEC rules within the US, so that they could, cater the offering to the United States investors. So the key regulations are Reg D, Reg A+, and Reg CF. Reg D has few rules upon which you can do your offering, but basically the key about the Reg D is that you have to do the offering to the accredited investors, and so it's pretty much is considered to be the private offering. Reg A+. So let's go through Reg D in details. So for Rule 504, the maximum offering is 1 million over the 12-month period. Rule 505, the maximum offering is 5 million over the 12-month period, and Rule 506, no limit on the amount. Next, number of purchases. No limit for 504, 35 unaccredited investors for 505, and unlimited accredited investors. And 506, same thing, unlimited accredited investors, 35 unaccredited investors, but they have to be sophisticated investors. Speaking of the resale within Reg D, Rule 504 says it's freely transferable, so they unless they don't comply with the state law requirements, they can be transferable. With 504 and 506, there are the resale limitations. Mandatory information is not required for 504, and for 505, 506, the information must be disclosed to non-accredited investors. And the manner of offering is basically the general offering and solicitations under Rule 504, as long as they are restricted to accredited investors. So you can solicit, but they have to be focused on accredited investors only. With the other two rules, you cannot have any general solicitation at all. Well, Reg A is basically the rule for larger audience. You can raise up to 20 million with Tier 1 and 50 million with Tier 2. Speaking of general solicitation, it's permitted before qualification in both cases. And in terms of investor requirements, you have none for Tier 1, and non-accredited investors are subject to limits within the Tier 2, within which you can raise up to 50 million. Speaking of the SEC filing requirements, so Tier 1, you have to file the Form 1A and 2 years of financial statements. It's basically same for Tier 2, but there is a bit more requirements on what kind of financial statements you have to provide. There is no restriction to resale in any of the tiers, and there is a preemption of state registration for the Tier 2, but not for the Tier 1. Reg CF, basically known as the crowdfunding ability. Annual offer is up to $1,070,000. General solicitations is permitted with certain limits on advertising. Investor requirements. There are limitations based on annual income and net worth. Speaking of the SEC filing requirements, you have to file the Form C and 2 years of audited financial statements. You have 12 months restrictions on resale, and you have the preemption of state registration. Now let's review your European Union. There basically is the EU Prospectus Directive, which is developed for the projects that are going to distribute tokens, and the Prospectus Directive is designed under the Financial Services Action Plan to cover the whole European Union with one regulation which governs security token offerings. So you should definitely check that out. I'll leave you the link to the presentation. You will be able to get yourself acquainted with the directive in details. Now, speaking of the most friendly STO jurisdictions globally, those would be Lithuania, Israel, Singapore, Estonia, and Malta. There are definitely more, and the list is growing. In our future issues, we're gonna talk about other jurisdictions such as, for example, Liechtenstein. So stay tuned.